Thanks for clicking! All eyes were on the Bank of Canada this morning as it was set to make its highly anticipated interest rate announcement, with the majority of economists expecting the bank to hold rates at 5%. We got our answer at 9:45 this morning, adding to the unrelenting surprise of the real estate industry when the Bank of Canada did in fact hold interest rates at 5%.
Shocked. We're all shocked.
Yeah, and the news comes as yields on government bonds are surging upwards, with U.S. inflation data coming in hotter than expected for the third month in a row. But the real news came at the press conference held shortly after the release of the policy announcement, where the media flexed its journalistic muscles, asking the governor 5 times about interest rate cuts. And, as we'll see, this time the governor actually answered, though that didn't stop them from continuing to ask. The governor always looks so happy to be there, doesn't he? Speaking of happy, congratulations to the 68% of respondents on this channel who correctly predicted how many times the governor would be asked the same relative question.
Yay!
But the governor was also asked some real concrete questions. He was asked about the US CPI data that came out today, he was asked about the housing market, and about government spending. So what I want to do today is go over the bank's policy decision, take a look at the press conference, and then discuss some implications stemming therefrom. As we'll see today, the Bank of Canada is adamant that they remain data dependent and that inflation risks still continue. StatsCan is set to release Canada's inflation data for the month of March next week, and we'll obviously have an update out on that, as well as the Canadian budget, on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this policy announcement. On to the announcement. As mentioned, to the surprise of no one outside of the real estate industry, the Bank of Canada held rates today at 5%.
I was shocked.
The bank, similar to previous policy announcements, expressed optimism that measures of inflation, both core and headline, are slowing. However, the bank also stated that inflation is still too high and upside risks remain, stating that the bank is still waiting to see sustained downward momentum in core inflation. And that makes sense, given the 3 consecutive upward moves in inflation coming out of the US, the bank is no doubt reticent to make a premature move. The bank also noted, as it has in previous policy announcements, that in assessing whether or not to cut rates, it will be looking at 1. Inflation expectations, which, as we've covered, have stalled out higher than the Bank of Canada wants them to be. 2. Wage growth, which is growing faster than expected. And 3. Corporate pricing behavior, which, according to the most recent Business Outlook survey, the number of firms planning on increasing their prices is actually increasing, and still above pre-pandemic levels. With that said, the governor did expand on these risks at the press conference, where, the first question out of the gate, rate cuts.
The door open to a rate cut in June. Is that within the realm of possibilities for you?
And finally, after over 2 years, the governor answered the question.
Yes, it's within the realm of possibilities.
Maybe, baby.
So, there it is. After 9 questions this year and untold questions last year, the governor has finally said a date where we might see a rate cut, where a rate cut is not out of the realm of possibility.
If things evolve broadly in line with the outlook that we published today, we will be becoming more confident that we're clearly on a path to 2% inflation, and it will be appropriate to cut our interest rate.
What do we do now? What the do we do now?
Yeah, given that the governor had finally answered the question, one would expect reporters to maybe move on, ask other questions like, will the US CPI data that came out today have an effect on monetary policy? The governor was eventually asked that, as we'll see, but that came much, much later. Instead, the next question, rate cuts.
Just to continue on Ajut's question, I mean, between now and
For his part, the governor went through a number of indicators that he had already gone through previously and that were fully available in the policy statement, and then went on to discuss why the bank is worried about cutting early.
What is on our mind is that the decline we've seen in momentum is very recent. Wage growth has only just started easing. Inflation expectations for households are only coming down very slowly.
The governor was then asked 2 more times about rate cuts, with the Wall Street Journal asking if any members of the governing council wanted to cut rates today. And then the Financial Post asked the same question later on.
I wanted to follow up on the diversity of views that you mentioned earlier in response to Paul's question, I think. I know you don't want to get ahead of your summary of deliberations, but that was raised in the last one. So I just wanted to ask if you could elaborate a a little bit on where that is. Is it on the in terms of the evidence needed for a cut?
The governor kind of laughed off the question and then went on to reiterate what he had said 20 minutes prior.
I think it's hard to be much more precise. I don't know if you can. You were sitting at the table with me. What anything to add from your perspective?
Yeah, there's 6 of us. It would be really unusual if we all showed up with exactly the same view.
And then the 5th rate cut question was actually a good one, especially given the US CPI data that had just been released.
Inflation tends to be highly correlated with U.S. inflation. The latest readings show U.S. inflation running about 70 basis points higher than Canadian inflation and rising. So could such a divergence continue for a long time? And if U.S. inflation continues shooting higher relative to Canada, should Canadian borrowers expect that the bank would be materially less likely to cut rates this year?
The governor answered by stressing that not only had the bank not had a chance to look at the U.S. data, but also that the bank was going to focus on domestic developments.
Look, we're focused on where we think inflation in Canada is headed.
Given that the Bank of Canada, for the first time in this cycle, indicated an almost firm date of when they might consider cutting rates, in that bond yields barely responded, investors at least are certainly considering U.S. developments, and I find it difficult to believe that the Bank of Canada isn't doing so as well.
Well, I didn't ask you what you think.
With that said, the conference wasn't all about rate cuts, with the governor being asked about house prices, in that, according to the Monetary Policy Report, house prices are seen as a risk to inflation.
Can you just kind of take us through the assumption on that, and when it comes to deliberations on potential increased interest rate moves, how much consideration is put into what will happen within the housing market?
The governor deferred to Senior Deputy Governor Rogers, who stressed that although house prices are a risk to inflation, they're only one of many risks to inflation.
What we outline in the risk section is that increase could be more than we anticipate, and if that were to happen, that could put sort of pressure on overall inflation. But what I would stress is, it's one of the things that we take into account when we make a policy decision. It doesn't rest on our decisions don't rest on any one indicator. As the governor's outlined, we think about a lot of things, and we outline more than one risk. So it's there. It's one of the risks. It's not the only one.
So, yeah, despite what we see from the media, despite what we see from the usual suspects that argue that we need to see rate cuts in order for housing to become more affordable, the Bank of Canada is well aware of what is going to happen to house prices if they cut rates too much. And finally, the governor was asked about government spending, the details of which will be released in next week's budget.
There will be a new federal budget before the next rate decision. We've already seen some new spending measures announced. Can you talk about how the bank will be evaluating the potential effect of those measures at the next meeting?
The governor gave the usual caveat that the Bank of Canada does not get involved in fiscal spending, but rather just reacts to it and incorporates that spending into its projections, and then went on to say that new government spending, the spending that we're going to hear about in next week's budget, has not been incorporated into the Monetary Policy Report's projections.
As you've seen, there have been a number of provincial budgets. We have built their spending plans into the outlook we published today. Obviously, the federal budget is a week from now, so we don't have the budget. We have not included changes in the federal spending plans in this outlook.
So today's Monetary Policy Report, which predicts inflation will be back at 2.5% by the second half of this year and down to 2% by 2025, does not incorporate any new spending, any new deficit spending into its projections. Kind of seems like they could have done a better job coordinating on those dates. Also, as a brief aside, and this is neither here nor there, the tech guys definitely weren't on their game today, as we had a hot mic moment coming from the Bank of Canada governor.
And shipping companies are also diverse.
The central bank lost its green screen at the second half of the conference, and the CBC wasn't able to figure out the mute button.
If you can come off mute by the time I finish this sentence, then you can have a question. Otherwise...
But that's neither here nor there. So, while the media and you-know-who will no doubt parrot the key takeaway from this conference, that a June rate cut is within the realm of possibility, I think there are a number of other key takeaways coming from the Bank of Canada governor, in that the governor has left himself a lot of room if he decides he doesn't want to cut in June. The governor has listed house price risks in that if house prices take off, that could put upward pressure on inflation. They're going to do it to themselves again. And the bank also hasn't incorporated government spending into its projections. If the Bank of Canada continues to see hotter than expected inflation coming out of the United States, if we get a surprise read to the upside here in Canada, don't be surprised if that June rate cut within the realm of possibility gets pushed back. Despite what we'll hear on social media, this is by no means a firm date set by the Bank of Canada governor. The usual suspects rarely read the lines themselves, let alone between them, and the governor has given himself a lot of outs if he wants to push that date back. As such, the next two inflation reads are going to be key in the run-up to that June announcement, and we'll obviously have an update out on those reads on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.